Everybody, and welcome to this webinar on financial crime risks in Ireland's banking and payments sector, which is brought to you today jointly by Mason, Hayes and Curran and the Banking and Payments Federation Ireland, BPFI. Now, look, it goes without saying that preventing and detecting financial crime is one of the greatest challenges for banking and payments institutions operating in Ireland and globally indeed today. And the risk is not only confined to monetary loss and regulatory scrutiny, but also loss of reputation, integrity, and culture. And it raises a myriad of issues. And to explore these issues, I'm delighted today that we've been able to assemble a really distinguished and knowledgeable panel. And so to introduce the panel to you, first of all, can I introduce Colette Hand? Colette is Senior Governance Manager in Group Financial Crime Compliance in Bank of Ireland. Colette has over 30 years experience in financial services, currently working in financial crime compliance. She's involved in the delivery of the financial crime risk management framework and manages regulatory engagement in the area. She holds a BFS degree from UCD, is a licentiate member of the Compliance Institute and Institute of Banking, and she's a certified data protection officer, QFA, and a professional banker. So welcome, Colette. Great to have you here with us. Also joining us from Bank of Ireland, we have Henry De Valera. Henry is head of fraud risk compliance in Group Financial Crime Compliance at Bank of Ireland. He has more than 17 years experience in banking, holding roles across risk and compliance, corporate commercial banking, and banking operations. He was Deputy MLRO for Bank of Ireland UK from 2021 to 2024. Welcome, Henry. Good to have you with us. Also, no stranger to any of you here from the BPFI community, Niamh Davenport, Head of Financial Crime at the BPFI. Niamh has been instrumental in pulling all of this together. Niamh, delighted you're here to join us today. And my partner colleagues from Mason, Hayes and Curran, again, those of you who are regular attenders on our financial services webinars, there'll be no strangers to you. Rowena Fitzgerald, financial regulation partner and co-head with me of the financial regulation practice here at Mason Hayes, and Peter Johnson, commercial litigation partner and with an extensive practice in financial litigation and in regulatory enforcement matters. So welcome to everybody. We're delighted first, I think, before we kick off the panel discussion, which is going to be a bit innovative, a bit different to what we usually do. Before we kick off the panel discussion, we're going to hand over to Niamh Davenport, and Niamh is going to open the comments and open the discussion with some comments on the key challenges that financial services providers are facing today when they're developing and implementing successful responses to the risks posed by financial crime. So Niamh, over to you.
Right, thank you. Yeah, I've got the eeasiest job today, I think. I don't have to sit in the panel today. So good morning.
There's nothing easy. Nothing easy. There's nothing easy.
Well, we'll see how it goes. No, good morning, everyone. It's great to be here today to discuss what I believe is one of the most pressing challenges, I think, facing financial services industry, and that's financial crime. At the BPFI, we see how financial crime, particularly over the last couple of years, has really become a systemic threat, not only to the financial sector, but also to consumers and businesses across Ireland. So it really is something that has changed a lot over the last number of years. Some things have stayed the same, but there has been a huge change in the scale, the sophistication, and the impact of financial crime, continues to evolve at an unprecedented pace. And it is fueled by technological advancements and increasingly complex fraud networks as well. This is why, particularly BPFI, we focus on prevention. Prevention must always come before cure. It's an old adage. It's basic, it's simple in one sense, but it's really the crux of financial crime and what we can do to prevent it. Once money leaves a victim's account, recovery is difficult and in many cases impossible because of the complex fraud networks. And it's not just about compliance or regulation. It's about safeguarding trust, protecting livelihoods, ensuring that financial institutions, regulators, technology providers work together and kind of try to stay ahead of the criminals. They are always one step ahead of us, and we're trying to close that gap as much as possible. So I think a number of challenges that are covered off in today's, or shown particularly in the case studies today, really are, I think there's three that I want to highlight. I think they're shown really well in the case studies, but in advance of that, the first one is the rise of social engineering. So financial crime, technology has changed it, but it's not just about technology. It's a psychological nature of financial crime that we're looking at a lot nowadays. It's how fraudsters exploit human nature, using trust, urgency to manipulate customers into handing over the money. So we're well aware of text scams, email scams, but it's how they do that. How do they get into our mindset? What is the wrapper? I call it the sweet wrapper. It's a box of sweets. What wrapper are they putting on the fraud or the scam, or how are they getting you to hand over your money? And it is psychological. They use things like, us being busy, things that are going on in the news. During COVID, we saw things around, being a close contact. During Brexit, it was around customs because we still weren't sure what was happening. So they're really clever in how they do that. So it's all just a sweet wrapper on what the fraud is underneath. So it could be romance fraud, investment scam, impersonation. These are rising in this country at an alarming rate, and criminals are becoming even more convincing in their tactics. One of the key preventive measures in this space is education and awareness. We run a program called FraudSmart, which is fraudsmart.ie. And the aim of this is to empower consumers and businesses with information to help them protect themselves, because the fraudsters are going directly to the consumers. They're going directly to businesses. They're not coming through banks. They're not trying to hack into our systems. They're trying to hack into the person is what we're looking at. So our first campaign in 2025 is actually specifically on social engineering. It's that detrimental to the financial crime landscape. And we're doing that in collaboration, which is really important this year, with Google. So they're actually supporting. It shows the cross-sector nature of what we're doing and what we're trying to get out there. So education is our first line of defense, I would say. If people can spot the warning signs early, we can stop the fraud before it even happens. So that's the first thing. The second challenge that we're seeing is legacy AML and fraud controls. And in the case study today, we'll explore that a little bit more. We highlight the consequences of ineffective due diligence, weak onboarding controls, and some outdated AML systems. And it is a real balance. There's so much coming at us in terms of compliance obligations, business pressures. We're looking at transaction monitoring, risk assessment, and remediation as well. And they all come at high cost. In a previous role, in a fraud role that I worked in, sometimes we used to be wishing for a big fraud case just so that we could get the controls in place, because it is such a balance trying to get that business case across. So why do we need it? We're not seeing any fraud in that area. That's because we're doing a really good job in stopping it. So it's how to get that balance across and get that business case. It's really important. And also regulators are increasingly scrutinizing our governance and accountability frameworks as well. So senior leaders must ensure that their organizations remain resilient to evolving threats and complying with the new regulations. I think as well, just to add to the regulation piece, we didn't have that much regulation in financial crime previously. We had our AML, fraud came under the CJA. So we're seeing now every piece of legislation that comes out of Europe. We have the instant payments regulation covers sanctions, a little bit of fraud in there as well. The payment services regulation, for example, is in draft at the moment, very heavy on fraud. I call it a fraud regulation. It's not a payments regulation at all. So it's, there's a lot, every piece of regulation that comes out now has something on it. There's DORA, there's all sorts of things happening. So it's a real struggle trying to keep up with everything and have all of those challenges looked at, even from a resourcing point of view, never mind anything else. And then the last piece I just want to highlight is the greater need for cross-sector collaboration. It's something that we talk about a lot and it's important, it's key. No one organization can combat financial crime alone. So we have to take a collective approach. And I think we've been doing that for a good number of years across the financial sector. We're meeting regularly, we share trends and analysis, but it's more than that. And like I said, it's evolved. So we've been working with Comreg as well over the last number of years on some projects, which has really helped stop spoof calls, for example. So it's really how we come together, how technology companies, telcos, law enforcement as well, and policymakers really come together. And we'll see that a little bit this year as well, with the National Anti-Fraud Forum being set up. And for the first time ever, having us all come around that one table, Commission the Man, for example, as well. All of these organizations and institutions coming together. We need more effective fraud intelligence sharing. We've been seeking the shared fraud database now for over 7 years, unfortunately. Finally, under the National Payment Strategy, that has been put to us, and hopefully we can get that up and running. We are still waiting on the legislation from the Department of Justice, but hopefully it's in train. And we also see information sharing coming out in the new AML, so particularly around Article 75. So it's how we look at that, how we align all of our policies and our procedures and get that real-time information sharing as much as possible. Because again, the more we can do in the preventive space, the better we're going to be. There's no point in us exiting one customer and then it goes down the road and opens up a bank account in another bank. We need to be able to share that information, and it's really important. So I'll finish by just saying the reality is financial crime, it's not just a compliance issue, it's a business integrity issue, consumer protection issue, a societal issue. They're all linked to something really important. I think something CBI are looking at as well as, one leads to the other, the impact on society that's happening. We really need to focus on education, information sharing and collaboration. And I think we'll be in a much better space as we go forward. So I'm looking forward to the session. I know it's going to be a really interesting and dynamic chat as well. So yeah, I'll hand it back to you, Liam, to get the panel started.
So much, Niamh. My God, you made that look easy, but there's so much content there.
That was heard me say a few of those things before, but
no, that was great. That was great. And look, I think that's really set the scene well for what's going to come next in the panel discussions. So we're going to use a case study format, as Niamh said, to draw out and discuss some of the legal and practical issues that come up in the area. If you've got questions for the panel, there's a Q&A function here in Zoom, on the Zoom platform, which you can enter those Q&A into. Obviously, the discussion's based on the case study, but you don't need to be limited by the facts of the case study in your questions. So let's start setting the scene. So there you see the first part of the case study. So New Bank Ireland is a wholly owned subsidiary of New Bank Global, having been acquired in 2021. During the acquisition due diligence, NBI's AML CFT policies and procedures were found to be outdated, but no detailed file reviews were carried out as part of the diligence exercise. Following the acquisition, NBI's AML CFT monitoring systems were upgraded so that they matched the NBG group-wide system, but no legacy remediation works were carried out. So the first question I'm going to put to you, Rowena, could I first turn to you? We're told NBI is heavily reliant on group systems for AML CFT purposes. Nothing wrong in that, I guess, or do you have any other thoughts?
Yeah, thanks, Liam, and good morning, everyone. So I think, yeah, there's a few things to mention in terms of that case study, Liam. Firstly, to your question, look, while relying on group AML systems, it's not banned, but when an entity becomes heavily or over-reliant on them, that's where we see issues from the central bank's perspective. It's completely expected that when you're part of a group, there's going to be some common group practices and systems in place, and that various subsidiaries and group companies will adhere to them. But there still has to be checks and balances at the Irish end. The case study mentions NU Bank Ireland systems being upgraded so that they match the group-wide system. So for NU Bank Ireland, some of the things they should have considered are, was an assessment carried out at the Irish end to make sure that the relevant monitoring systems met the regulatory obligations that apply to the Irish operation specifically, and that those systems satisfy all the areas and the data points that the Irish operation has to monitor. They should also have considered things like whether the systems were calibrated correctly to take account of the actual money laundering and terrorist financing risk to which the Irish entity is exposed and not just the group. And I think, coupled with that, another consideration that NU Bank Ireland should have been looking at here was outsourcing and oversight of the outsourcing. So when you rely on group functions or systems, the Irish operation should be considering if an intergroup outsourcing is taking place, and they should absolutely be considering how that outsourcing is being controlled and monitored from Ireland, and looking at things like, who's responsible within the Irish operation for outsourcing, given that, look, an outsourcing like this is bound to be material. Someone needs to be accountable for it in Ireland. So sometimes for firms that are part of a larger group, particularly small firms, it can be difficult to get, sufficient resource in place in the Irish operation to look after all of these areas and risk. But the reality is that regardless of size, there has to be appropriate oversight in place at the Irish end.
Okay, so maybe a few things might have been missed there, but judging by what you're saying, Rowena. Peter, can I bring you in next? Is this an area that the CBI has been active in terms of enforcement? Is it one that they have their eye on?
Yeah, and thanks, Liam, and morning, everyone. I mean, as mentioned, the CBI is the competent authority here to oversee, I suppose, credit institutions and financial institutions as to whether they're appropriately complying with their AML and their CFT obligations. What's relevant, I suppose, most recently here is in 2022, the CBI reprimanded and fined Danske Bank 1.8 million, effectively for 3 breaches of the Criminal Justice Act. What happened there, very, very briefly, was that Danske is a Danish entity that operated here in Ireland as a branch. And in 2010, when the Act came in, it failed to update its own internal automated monitoring systems. So it never applied the new regime to its existing systems. And because of that, then it led it to exclude certain category of customers from transaction monitoring, which should have been reviewed or considered for the purposes of compliance with the Act. And that's what gave rise to effectively what I'm calling 3 breaches under the Act. And those breaches were, in short, that for a period of 9 years, so it was a long period of time, that Danske had failed to identify, using its systems, those certain categories of customers that potentially had money laundering or terrorist financing risk. And because it hadn't got that function or hadn't monitored those types of customers, it then didn't know whether it was required to conduct any further enhanced customer due diligence. And then finally, it didn't have proper policies and procedures in place. And it kind of sounds obvious. If it had proper policies and procedures in place, it would have been able to identify and say, hold on, our transaction monitoring here is deficient. And because of this deficiency, it's giving rise to this issue where we don't know who we should be applying enhanced customer due diligence to. I think one thing to note, and Rowena has touched upon it there, is, you know, when the CBI published the fine and the details around the settlement, it noted that one of the aggregating factors when it imposed the fine was the fact that this offence had been going on for such a period of time. So while Danske knew of this legacy issue in 2015, the Irish branch never found out until 2019, and then the CBI was informed then at that stage. So it was that long period of time which was seen by the CBI as an aggravating factor. And I think to go to the case study, and probably to chime with what Rowena has said there, in the public statement that went with the settlement notice that the central bank published, you know, the Director of Enforcement and Anti-Money Laundering, you know, did flag that, yes, you can have internal automated systems, but they need to be regularly monitored to ensure that they are in compliance with regulatory requirements. I think the Danske Bank example is a good one in that it demonstrates what can happen where you have an entity working here which is plugged into a wider system, but because there's no communication or there's a breakdown there, you have a situation where, you know, updated regulatory requirements are not being communicated appropriately internally, which can cause significant, I suppose, financial exposure and reputational exposure for the firm.
It's great, Peter. Thank you. And obviously, with Ireland as a hub for subsidiaries of multinational corporations seeking to access the European market, and very often with reliance on shared group systems, it's one to definitely keep an eye on. Colette, there's another strand to the case study, or this part of the case study, which is the issue of remediation of legacy issues. We're told that NBI did no legacy remediation works following the acquisition. Now, you might shed some light on your experience in respect of CBI expectations in relation to remediation of legacy issues.
Sure. Thanks, Liam. I suppose, look, certainly in recent years, as others have mentioned, we've seen increasing CBI involvement in these matters. They've certainly raised their expectations in relation to the remediation of legacy issues. Not only that they're resolved, but also that you know, there are robust assurance processes put in place to make sure that they don't happen again. And as Peter and Rowena have touched on, you know, you'd have hoped in terms of NBI that during the due diligence carried out in the acquisition, it would have driven out whether there were any kind of issues or deficiencies. But I suppose nevertheless, once an issue has been identified, it's important that steps are taken as quickly as possible to address them. And I would say that, you know, a group-wide approach would need to be taken so that you're not just resolving an issue in one area, but you're making sure that there isn't a similar issue elsewhere that you don't yet know about that might happen down the line. So once there's a handle on what the issue is, its cause, other subsidiaries, if there are any, or business units should be alerted to investigate and make sure that there isn't a risk that they have sort of similar kind of problems in their own operations. And then I suppose in practical terms, then, you know, the key to successful remediation of legacy issues is setting yourself up for success, sort of in terms of bringing together the right people from the outset. So, you know, establishing a working group with relevant subject matter experts. You know, you're going to need people with technological expertise, data management, business analysis, and so on. And you are also going to need a sort of a steering group, which typically would be made up of sort of senior leadership. They'll be the decision makers. They're the ones with ultimate accountability for the remediation. And I suppose then, just in terms of the central bank's involvement, you know, they will want to see an action plan that's detailed, that's durable, that has, you know, effective and measurable actions set out with clear timelines, and they will want regular updates on the progress of that action plan. And, you know, it's important for everybody in the working group that if there are any issues that arise, and, you know, these things happen, of course, particularly when you're dealing with, you know, a complex issue, if there are any issues that arise that might jeopardize the delivery of, you know, any of those actions, they need to be escalated at an early stage so that corrective action can be taken. There's also a whole, you know, world of reporting that goes on in that space, both internally and externally. Sometimes the central bank will prescribe the timelines in which they want to receive updates. Usually that's kind of quarterly or so on. But most certainly at the end, you know, they will want to see that the action plan has been delivered and that it can be evidenced. And, you know, another key, I suppose, to success is having assurance processes that check and validate the embeddedness of those actions taken. You know, so typically at the end of delivery of an action plan, you would have, you know, your risk assurance or your internal audit come in and just validate that you know, the actions have been successfully delivered, but that the updated processes and systems are fully embedded and that they're working effectively.
It's fantastic. Yeah, great practical advice there, Colette. Thanks for that. Carolina, we might just move on to and add a few more facts to our case study. So now we're introducing John. John is a new character to our drama. John is a successful businessman and long-standing customer of NBI. One day he's using a popular dating site. We're not naming the site. John begins chatting with Laura, who's also a customer of NBI. They continue messaging, and Laura tells John she's pumped all her life savings into a new business and is now struggling with the cost of living crisis. So John, being the white knight, offers to invest €1,000 into her business on condition she repays him in full within 3 months. She sends him a push payment request via her NBI banking app. John transfers the €1,000 and surprise, surprise, at the end of the 3 months, Laura seems to have disappeared. Henry, I'm going to bring you in here now. Obviously, John has found himself in a sticky situation. You might talk us through, please, some of the common types of account fraud which are being deployed out in the market against customers and the kind of steps that banks are taking to protect customers against those frauds.
Thanks, Liam. Yeah, and I suppose just I really like the analogy that Niamh used at the outset there, which is that for a lot of these frauds, the frauds themselves don't really change over time, but it's the sweet wrapper around them that does. So we're kind of, everyone on the call would be familiar with, you know, invoice redirection, identity theft, authorized push payment fraud. And while it's not limited to those types, particularly at this time of year with Valentine's Day around the corner, we can see an increase in romance scams, which certainly seems to be the main driver here. These types of scams usually involve the creation of a fake online identity. and can involve even celebrities, as fantastical as that can sound, to gain a victim's affection and trust in order to exploit them financially. And they're horrible cases. And it's not to say that there's any particular fraud is worse than another, but these can, there's a real tangible impact on people's lives with these cases. So firms can need to be, and organizations need to be vigilant and familiarize themselves with the indicators of all types of fraud. And again, in touching on what Niamh said as well, is that customer and staff awareness is really the first line of defense associated with being able to protect customers as well as institutions from these types of scams. So there's common characteristics that you may look out for in these ones, such as out of course transactions, money being sent overseas where previously all of the activity would have been domestic, or unusual fund transfers and frequency. And what you see in these instances, it can often be very small amounts followed by much larger amounts over a period of time. So it's really about putting in place appropriate processes and procedures to best arm the staff of organizations when engaging with customers. So it may be as simplistic as making inquiries as to the purpose of a transfer or payment, or has the customer transferred funds to beneficiaries in the past, or even has the customer met the beneficiary in these cases as well. So, I mean, there's obviously there is an obligation on the part of a firm to make sure that any automated systems or fraud detection software that is being used, that sufficient, or is it adequate, or is it appropriate to be able to identify these types of transactions. But they can often be very difficult to identify through those methods. So it can really be, the onus is on the organization to make sure that staff are best armed with, these red flag indicators, and that also that a concerted effort is being made to go out to the public, to the customers, and help educate them on the types of scams and types of frauds that you're seeing out there, and how best to protect themselves from it as well.
That's great. Thanks so much for that, Henry. We'll move on, Carolina, on to the next part of the case study. So poor old John is high and dry for his €1,000. 1,000 is actually, I mean, this case study, obviously, but I did read, back to Henry's point, I read of a case recently in the news where a lady had transferred €700,000, which was her entire divorce settlement, I believe, if I'm correct in my recollection. So it was all the money she had to live on, in fact, to a fraudster in one of these romance scams. So as you say, Henry, they can really be devastating to people. So what can poor John do? So John contacts NBI, wants a refund of his €1,000, arguing that NBI's account facilities were used by Laura, quote unquote, to defraud him, and NBI should be responsible. NBI refuses a refund, so he lodges a complaint. The complaints team investigates. It seems that John's money was in fact paid into an NBI account that had been opened by a man called Alex. There's no KYC information relating to Alex held on file at NBI, unsurprising given the legacy issues that we talked about earlier, save for a copy of an out-of-date driving license. The case is now escalated to Mary, who's appointed as NBI's head of compliance, AML compliance, and head of compliance 2 months ago. She's a lateral hire from a much larger institution and is still getting to grips with NBI's systems. Rowena and Peter, I'm going to bring you both back in here just to talk about the legal and regulatory responsibilities of firms when dealing with customers that have been the victims of frauds. Rowena, maybe if you could comment on the regulatory aspects of that first.
Yeah, I think, thanks, Liam. This one is tricky, and I don't think there's a one-size-fits-all when it comes to how an institution has to deal with the victim of fraud. I think it all comes down to the facts of each case. I think at the outset, from look a bank and financial institutions perspective, I think it'd be an impossible task to ensure that fraud doesn't happen. However, a bank does need to have appropriate steps in place, and it needs to act in the best interests of its customer to try avoid such fraud happening. I think Aenri gave it great insights into that one. As a side note, just to mention, when dealing with, say, card payments and fraud relating to these, there's more scope to retrieve funds. So, banks have more scope to be able to kind of facilitate a victim and get their money back by using a chargeback. And for anyone who isn't familiar with that term, a chargeback is a reversal of a previously cleared card transaction where the cardholder's account is credited and the relevant merchant or the payee's account is debited. So basically they get their money back. Unfortunately, the same mechanics don't apply when dealing with authorized push payments like we're seeing in this case study. And when it comes to fraud more generally, the central bank's expectation is that firms have, effective measures in place to mitigate the risk of fraud, to be proactive in identifying fraud, and to, work with victims of fraud. And we'll see, look, like Niamh mentioned, there's going to be a very heavy focus on fraud in the future. We've PSD3 coming down the tracks. We also have proposals under the new revised CPC, which provide that, firms have to be, I suppose, more targeted when dealing with fraud. And it says that, it's going to provide for a specific section relating to financial abuse. And it requires that firms have to work together collectively to ensure that, their systems are resilient to and responsive to the ever-evolving threats of fraud from external factors. And the Central Bank mentioned that in the consultation paper relating to the revised CPC. But the main outtake, I think, or uptake from the revised CPC is that there is going to be this concept of financial abuse, which is very broad, and it's definitely going to include, frauds and scams. And one interesting point on the revised CPC, and one that's a new departure, is actually that it's going to impose an obligation on regulated entities to have clear policies and procedures for its employees to report internally on concerns they might have that a person, a consumer, is at risk of financial abuse by any person. So to round off, the whole area of fraud is very complex, but in summary, regulated entities are expected to be responsive to the ever-evolving fraud threats facing both them and their customers.
That's great, Raina. Thanks. So clearly they have to have the structures, they have to have the policies, the processes, but not necessarily from a regulatory perspective, an obligation to make a refund. Peter, from the legal perspective, what are the circumstances in which a regulated firm might have legal responsibility to a customer in a case of fraud?
Yeah, so I suppose here what you're looking at is the sort of the common law duties that a bank might owe to its customers. And in general, what that is a general duty to exercise reasonable care and skill. So in this case, when executing an order to transfer funds or any other services that a bank might provide to a customer. There's been a lot of case law in England in particular around the duties that a bank may owe to customers arising from third-party fraud, and in particular push payments. And the case there you mentioned earlier about the 700,000, that's the Barclays Bank case from 2023. And that the case law effectively centres around this concept of what's called the quince care duty. Now, you're probably saying to me, what's that? So what that is it's a duty on a bank that requires it to refrain from acting on a payment instruction given by the customer's agent if the bank has reasonable grounds to believe that the agent is defrauding the customer. Now, I'll say that again just so that it's clear. It's a requirement on the bank to refrain from acting on the payment instruction given by a customer's agent if the bank has reasonable grounds to believe that the agent is defrauding the customer. So it's really an offshoot of the general duty that the bank already owes its customers to act with due care and skill. And really, it focuses around the bank being put on inquiry. Are there reasonable grounds for the bank to believe that there's an attempt to defraud the customer? And in fact, the instruction is not in fact authorized by the customer, and the agent is up to no good. And to look at I suppose the case summary here, or what's of relevance here, is the fact that John himself instructed the bank to do it. It wasn't any third party, so quince care doesn't apply. This is somebody directly making the instruction. And the other point then, I suppose, to highlight is that in that situation, really, the fraud here arises from not from the instructions, but by the actions of the third party. So therefore, John's recourse is to chase the fraudster, as difficult as that may be, but as against the bank, doesn't arise in the circumstances in the case study.
Great, thank you, Peter. Thank you, Rowena. So let's move on, Carolina, on to the next part of the case study. Mary's on the case now, so let's see what Mary discovers. So she goes digging. She discovers that Alex's account has actually been credited with hundreds of payments of €1,000. So he's been a very busy boy on our dating app over the previous year, from multiple bank accounts in multiple jurisdictions, including several in high-risk jurisdictions. On looking further, Mary also discovers that within the last 18 months, Alex made a payment out of €5,000 from his account to an NBI account belonging to Dennis, who's a senior official in the Ministry of Finance in Cameroon. And this was not flagged as suspicious at the time by NBI's AML CFT monitoring software. Alex also made a payment 6 months ago of €200 to Jim, who's a known hacker in the Philippines. And again, these were not flagged as suspicious at the time. Henry, this all feels a bit odd to me. There's all these payments going out to high-risk jurisdictions. I'd have thought there'd be some obligations on the part of NBI here. What would you think?
Yeah, absolutely. And it's even, the red flags when reading through the case study are quite clear for us all. I think everyone on the call will be fully cognizant of their obligations as respects to the monitoring of customers' transactions and the reporting of any suspicious transactions under the CJA, and the regulatory expectation to employ a risk-based approach to that monitoring. So, for example, where transactions are inherently of a higher risk nature, so applying it to this particular case involving higher risk jurisdictions, the application of monitoring will obviously need to be enhanced to reflect the risk. In this example, I would have expected Alex's account to have flagged or alerted due to the ongoing nature as well as the high risk jurisdictions. So that would suggest to me that that NBI should need to put in place a review, or maybe leverage off their internal or external assurance or audit partners in order to best assess the effectiveness and adequacy of their programs. But it would also, you would expect as well that in the realms of actually reporting the activity across it, that any alert, if it were to arise, you'd probably be looking at a level 2 or some other investigator to perform maybe a degree of enhanced due diligence over the activity on the account, the payments, and the customer themselves. So it's really looking at whether or not there's a reasonable explanation for the receipt of these payments, and does it give a rise to any reporting obligations, both from an AML suspicious transaction reporting, and then as applying it to the previous instances, a Section 19 report to the authorities for the probably quite clear fraudulent or the concern surrounding the frauds on the account.
Great, thanks, Henry. And Colette, you have a few thoughts on this, because we've got some political connections here, don't we?
We do
knocking
indeed.
Around.
Yeah, I suppose, following on from what Henri has said in terms of, transaction monitoring, there's also a piece here in terms of, customer screening. I would certainly expect that Dennis, as a senior official in the Ministry of Finance in Cameroon, would have been identified, in terms of customer risk and know your customer processes as a politically exposed person, or a PEP. And, that would ensure that his account would be subject to enhanced due diligence, enhanced monitoring, both in terms of, the transaction activity, and just in general, the operation of his accounts with NBI. So I suppose the concern here really would be that Mary, as the MLRO, has possibly much bigger problems than she might have thought at the outset here. And again, as Henri has mentioned, you would expect your screening systems to undergo effectiveness reviews. That would be a standard practice. So if I were Mary, I would be looking to see when the last effectiveness review was carried out. Were there any sort of concerns flagged there? And then, as a matter of urgency, I suppose, as Henri has suggested, to have that external review piece carried out as soon as possible. Because if you've missed flagging Dennis as a PEP, there is every possibility that there are other instances that may not have been flagged that should have been.
So poor Mary may have stirred up a hornet's nest by having this complaint escalated to her. And so she's some fairly serious issues on her plate. Let's see, Carolina, we'll take the next slide and we'll see what she does next. So she now suspects, and this is what you're both saying, Henri and Colette, she suspects there may have been long-running defects in NBI's AML, CFT, onboarding and monitoring processes. And she also suspects NBI accounts may have been used to facilitate widespread fraud against their own customers and customers of other banks. So she escalates these issues to Brian, who's the CEO, and recommends a full external review, as you said, Colette, of NBI's historic compliance and of the effectiveness of its processes, and also recommends immediately informing the CBI. Brian brushes her concerns aside, telling her he personally oversaw the implementation of the enhanced systems following the acquisition. And he says she should just activate a refund to John, freeze Alex's account, and let the matter drop. So, somewhat strange reaction, I think we can all agree. Rowena, if I can turn to you first on this, what kind of position do you think Mary finds herself in here, and what are her obligations?
Yeah, so to echo your sentiments, poor Mary. She's definitely not getting the internal support you'd need as MLRO and as the head of AML and CFT in these circumstances. So yeah, I think Mary has to now consider her own position. But look, if we park Mary's obligations just for a minute, I think it goes without saying that NU Bank Ireland itself should be informing the central bank of these matters. And like Peter mentioned, the Danske Bank enforcement earlier, and one of the key criticisms of the central bank as part of that was a delay in notifying them of the relevant issues involved. And that was actually an aggravating factor in that particular action. So look, it's very clear that the central bank expects firms themselves to bring failures to its attention at the earliest opportunity. But turning back to Mary, I think the first thing to note is that as a PCF in a bank, Mary is subject to the central bank's individual accountability framework, including the senior executive accountability regime. So the central bank's guidance on IAF specifically reminds individuals holding PCFs that they have reporting obligations under both the Central Bank Act 1942 and then pursuant to the additional conduct standards that apply to them under IAF, where they believe that there's a prescribed contravention. And by way of reminder for everyone, a prescribed contravention is effectively any breach of financial services legislation. In addition, for Mary, there's also a further obligation. The central bank's protected disclosure regime requires that PCFs disclose information relating to prescribed contraventions to the central bank, where the PCF believes that that information will be of material assistance to the central bank. And looking at kind of the whole area of prescribed contraventions, transaction monitoring is one of the key limbs of the anti-money laundering framework, and it's a specific obligation under the Criminal Justice Act 2010. So what it seemed to me, based on the case study, that Mary should now look to make a report herself to the central bank.
Sorry, thanks, Rowena. Peter, it seems the whole situation's a bit of a mess. Should NBI and its senior individuals, do you think, be concerned about potential exposure to CBI enforcement? And what steps do you think NBI should take if the CBI come calling?
Yeah, so it's all a bit of a mess now, isn't it? I think the CBI are probably likely to come calling, and just to sort of take a step back, when will they come calling? Well, they'll come calling when they, open an investigation, or they will open an investigation where they have reasonable grounds to suspect, as Rowena said, that there's been prescribed contraventions by the firm or the individual. what can they expect? To be honest, that's a whole seminar in and of itself in terms of the ASP procedure, particularly given the revisions that were introduced in 2023. But to give a couple of sort of cliff note answers or takeaways for the purposes of the seminar today, the process commences with receipt of the notice of investigation under the old regime. This used to be called an investigation letter, and this effectively sets out the allegations of the specific prescribed contraventions, and the regulated entity or the individual is given a time period within which to reply. I think if you remember nothing other than this from my section, it's really important that a lot of effort and time is spent in responding to that investigation notice. The reason I say that is because it really sets the scene as to how the investigation will progress going forward based on the content of your reply. And I think it's important to appreciate and understand that when doing that reply, for example, using the case study here, these all are legacy issues. It could take some time internally to really get your arms around and understand what those legacy issues are, what documentation is around dating back to those times, to understand all of that, to be able to respond properly and comprehensively. And you may need external legal advice depending on what's going on. And all of that may have to be done before you respond to the notice of investigation. And, the timelines that you typically get when you receive the notice aren't particularly generous. So, if that's, apparent from, early doors that you're going to need more time, I would certainly suggest that, you engage with the central bank to seek that time and explain why you need it, because I think it is important that the regulated entity or the individual is given sufficient and reasonable time within which to respond to the allegations. Once you've responded, typically what follows is a request for documentation from the central bank. And that's effectively you handing over your internal documentations that relate to the prescribed contraventions. It's important and maybe obvious to say, but it's important that whatever's in those documents is consistent and not inconsistent with what you said in your reply to your notice, because your reply to your notice will have gone first before the document request. There then follows quite a lengthy process, potential settlement opportunities along the way, or it ultimately can go to inquiry if you can't reach an agreed settlement with the central bank. So it's quite an involved process. The one other final comment, the final comment that I'd make in relation to, I suppose we've had two settlements under the revised ASP, is that the notices that the central bank, or the notices of settlement that are settlement notices that are being published on the website in relation to those two, are actually now considerably more detailed than they were in the past. And it's important to appreciate and understand internally when you're communicating with stakeholders as to what the process can look like, that the detail that can be now contained in those settlement notices, referring back in certain instances to documentation that has been handed over by the regulated entity to the central bank in that notice, so that people understand the full sort of spectrum and gamut of what potentially the process can look like.
That's great, thank you, Peter. Now, Colette and Henry, you're the brave soldiers who have the responsibility of making sure that none of your senior people end up having to deal with those kinds of communications from the central bank. So, what would be your practical steps? Can I ask you just for practical tips in terms of how banking and payment institutions could go about, or can best go about protecting their customers and themselves against financial crime? Colette, maybe if we hear from you first.
Yeah, sure. Thanks, Liam. I suppose, I have a governance hat on, so my practical tip would be, in terms of your financial crime framework, to understand and be able to demonstrate how your firm complies with its legal and regulatory obligations, right down from your policies, your procedures, into your processes. What controls have you got in place? What is your oversight and monitoring in terms of those controls? There should be risk assessments carried out on at least an annual basis at business unit and enterprise level, just from a perspective of your customer risk, your product risk, your channel risk, and so on. And also, horizon scanning is really important, so that you can I suppose, anticipate threats, mitigate against them. And also, you know, all of that really is worthless if you don't have the right culture in the organization and the right support from a senior management level. So, you know, going back to the case study there with Mary and Brian, the CEO, I mean, that's obviously it's a made up scenario and you'd like to think that it wouldn't happen, but you most certainly need, you know, in a financial crime compliance environment, you need the support of senior management. You need to make sure that they are engaged in terms of their own obligations, you know, and supportive of that, I suppose, financial crime risk agenda, I might say.
Great, thanks, Colette. And Henri, your practical tip?
Yeah, I think Colette's kind of taken a lot of the wind out of my sails on that one. So, but I obviously completely agree with everything that she's saying there. It is, if from a practical standpoint, it is about regularly engaging with businesses within your organization. And that could be, there can be a case from a financial crime standpoint that a lot of times we're preaching to the converted. But it's about communicating and making sure that they are aware of not only the risks inherent within their organization and how best they can address those, but it's also with a view to horizon scanning and making sure that they are aware of, you know, financial crime is ever evolving. It's about making sure that they are, again, well equipped and well armed to address those and kind of bring that awareness into their purpose and values, and the communicating the utility of such awareness from a customer outcome perspective as well. I think longer term, and in speaking to that kind of purpose and value piece, it is incumbent on us practitioners in the field to ensure that that culture of financial crime awareness is seen and heard at a senior level within our particular organization. That can be tricky at times for sure, but it's the right thing to do, and it's again in being able to evidence the efficacy of that kind of awareness. And again, how we can bring that forward to help better protect customers in the wider society.
It's about making it practical, really, isn't it? And making sure it actually responds to one of the questions that have been put in the Q&A function, where one of our audience has asked, you know, is there a risk that AML CFT has become all about bureaucracy and box ticking? And actually, I think what you've said there just captures what you need to do to make sure that it's not bureaucracy and box ticking. It's that regular engagement with businesses. It's a focus on what's actually going on, the practical application, assessing the risks, having the senior stakeholders driving it as a central part of the culture. That's really what safeguards it against becoming bureaucracy and box ticking, isn't it? We might just take a look at the poll results, Carolina, before we move on to Q&A. So the questions we asked you all: has your organization seen an increase in financial crime attempts? No surprise, 70% say yes. And what proportion of any increase has been tech enabled? Interesting, yeah. People say, you know, between 50 and 75%. So I thought it'd be all clustered at the higher end, but in fact no. But still, tech is a significant driver of the increase in financial crime attempts. What does your organization need most to improve its financial crime detection capability? IT systems out the door. 41% of people say enhanced IT systems, and followed in second place by more regular training, 32%. Is your organization using AI in its AML CFT processes? 62% say not used. We might come back to that actually after the poll. How highly would you rate financial crime detection as a priority? No surprise again, 75% say it's a high priority in their organization. So on the AI point, Henri, might just take a couple of minutes from you on that. How realistic do you think it is that AI is really going to transform the landscape as far as AML CFT detection is concerned, or is it a bit of a fad?
I certainly wouldn't say that it's a fad. I'd be cautiously optimistic about the value of AI in the financial crime space. I think we can see quite clearly that the benefits of AI can be seen in enabling maybe more mundane, manually intensive tasks, and maybe bringing a degree or a level of automation to those, thus being able to free up more resources to kind of get their teeth into the bigger risks as well. So you can see that from maybe across the industry, or anecdotally across the industry, that a lot of what would have been considered the level one operational tasks across a range of processes. So you've got customer screening, transaction monitoring, and maybe more so in the last little while, elements of KYC, which have now started having AI adopted into those processes. And I think that that's probably born out of the results coming from that poll as well. Like the benefits of AI, you can see at it from an operational lens. You know, it's operating 24/7, or has the ability to operate 24/7. It's less likely to make mistakes, and it probably reduces operational burdens or inefficiencies in terms of the reduction of false positives specific to those kind of screening or transaction monitoring pieces. But there's probably caution that needs to be expressed in terms of that as well. We're still we're closer to the genesis of AI and its utility within financial crime than anything else. So there's obviously, the firms need to be sure that where they are implementing these AI models or AI or generative AI, that they are striking the right balance between reducing that operational burden as well as meeting the compliance obligations, and probably addressing inherent risks within the organization as well.
That's great. Thanks, Henri. There's a question in the Q&A function. Maybe Niamh, I'll address it to you from Dermot O'Brien. Dermot has asked, should the law be updated to address situations of attempted fraud? Because currently the Gardaí, when frauds are reported to them, only seem to take action if fraud has actually come through to fruition. And should we have a special sort of fraud squad, if you like, or fraud police squad? Do you want to give us your thoughts on that?
So yeah, well, the Garda National Economic Crime Bureau would have a department, an area there that would cover specifically financial crime. The biggest issue is resourcing. They don't have, I would say that they do not have enough resources. There was a consultation with the Department of Justice towards the end of last year. I think it was fine. We're waiting on the findings to be published now in January, hopefully. And that looks around the resourcing and the use of technology and how we can actually help resource the guards. What we would say is report everything to the Gardaí, whether money has been taken or not, whether you fell victim. And the Gardaí would say the same as well. And the banks would be doing that under the Section 19s, even if money was returned or if money wasn't taken, the frauds would be reported. The reason being, they need all of the evidence. So even if you didn't fall victim, if you have an IBAN that was maybe suggests to say, I think invoice redirection was the example there, that may be useful in another case. It may link it, but the Gardaí need the tools to be able to gather the information. I think on STRs, they had unprecedented amounts. I'm not sure if I can release the figures on it, but it's literally a six-figure number on the number of STRs that was sent to the Gardaí last year. And I think they were in the media recently on it, so I don't think it's too sensitive, but they need the tools and they need the resources to do it. And the likes of AI, this is where AI can help, because they'll be able to mine the data in a much more efficient time, rather than somebody sending it in. Even the Section 19 reports, while they're more templated now, they're still not automated like the GoAML system. So we need the tools to be able to report that. And what the Gardaí would always say to us is, one piece of information can pull it all together in a case and help prevent it in the other case, or get money back for somebody else. So even if you didn't fall victim and you have information, it should be reported. And all Garda stations should be aware of that. But there is the GNECB who will look after that. And if there was any ever issues, I know that that would be the answer that they would give.
Thank you, Niamh. That's great. We're out of time. I want to say thank you very much. That's been a really good panel discussion, really stimulating, lots of ground covered. Thank you so much, Colette Hand from Bank of Ireland and Henri de Valera, also Bank of Ireland. Fantastic to have the practical input on the panel. Thank you so much, Niamh Davenport. And I'd like to also mention thank you to Bernice Evoy, the BPFI, for the fantastic collaboration we had from you in putting this together. Thanks to Peter and Rowena. Thanks to all of you. Please fill out the survey and we look forward to seeing you soon. Bye-bye.